I think we have heard a lot about regulation. We're going to hear a bit more, and I think it's a critical topic that we are really wanting to explore a bit more in detail. So we have heard very high-level messages, from Commission, the ECB, as well as the EBF. Now we're going to focus a bit more with the banks and with ECOFACT as well on the concrete elements of the regulation, so we can cover a bit more deeply some of the issues that we have been seeing, and also the interplay between voluntary and mandatory requirements, which I think we have seen. We have heard about how compliance is important, but we need to also go beyond that, and how regulation is also not only about compliance, but it's also about the responsibility of the institutions as a whole. So in this panel, I'm very happy to have with me on my left Soudain, that is the head of regulatory advisory at ECOFACT, that is one of our sponsors. Then we have Marta García Oteyza Kindelan, that is the director of responsible banking at Banco Santander. So thank you very much. We also have Christian Castro, that is the head of public affairs at CaixaBank. And last but not least, another one of the sponsors, so Frida Mekoui, that is Director of Public Affairs at Societe Generale. So thank you very much for being here. And without further ado, I will start with Tennessee. I mean, what do you think are the key pieces of regulation that are really shaping the approach globally, but also in Europe? I mean, we have heard already from Marcel, very interestingly, the key regulations that the Commission has put forward. But what do you see this shaping the way towards 2050 and beyond?
Yes. Thank you so much, Daniel, and good afternoon to everyone. It's already good afternoon. It's not easy to speak just before the lunch, but hopefully the regulations will keep your attention. So to answer your question, I would say there is something important to keep in mind, is that all these regulations had the main purpose not to have only a compliance approach and a tick-the-box approach, but we also face an incredibly amount of regulations that are coming, and very, very more and more precise requirements that could challenge a bit the main purpose of this main approach. But if we go to the critical regulations, I would say to achieve the goal, the main regulations that we have now are about disclosures. And this we observe on a global level and also at the EU level. So we can say that we have the taxonomies, and here we can also divide between the EU taxonomy that is really at the company disclosure level, where almost all the other taxonomies in the world are more at the product level. We also have product requirements disclosure in the EU, like the SFDR regulation, but the taxonomy is really at the corporate level. Then we also have the CSRD, the elephant in the room, let's say, and the different standards. So the ESRS that were published a few weeks ago, and GRI and ISSB, of course. So the interoperability is quite a challenge, I would say, now. And this is where they are all working on. But the EU is quite advanced in that, and also they work very closely all together to make something consistent and usable for the companies. And then I would say the most advanced regulations that we have, or requirements that we have to achieve the net zero goal, are about the transition plans. And here we can observe that we have transition plans included in the ESRS, E1 and E4, so also about biodiversity. And also it has been proposed in the CSDDD. We also observe transition plans outside the EU, like in the UK. So this is something very advanced to achieve the net zero goal. And if we go a bit beyond only the disclosure, we can also say a few things to be quick, and then happy to answer any questions that you may have. So it's linked to the disclosure, but it's not directly about the disclosure. It's about the audit that disclosure will be now required to be audited because they want now, and this is the main purpose of the CSRD, to include the non-financial information into the financial statement if you have to publish such financial statements. So that's a huge thing for companies and for financial institutions. So the audit thing, that was also already a bit discussed, the ESG ratings, that is also coming, that they want to make it more coherent and transparent. And also something that is coming in the EU, but is challenging for everyone outside the EU, is the extraterritoriality of the requirements, because even as a non-EU company, you will have to disclose this non-financial information. And it's a big challenge for non-EU companies, wherever you're based. And how do you handle that at a strategic level if you do it directly at the group level and you disclose for all your EU entities and non-EU entities, or if you don't? So it poses a lot of different questions and challenges for companies. And the last one, if I have 1 second to say that it's something else that we also observe now. It's very, very new. And it goes into the direction of the strategy and the engagement. It's a new proposal that we have in France, and it's about say on climate. So that would be to engage your shareholders and to have your shareholders voting on your climate plan every 3 years, and the board of directors would have to report annually on the implementation of the plan. So it's very, very new. It has been proposed a few weeks ago in France. We don't know if it will be adopted or not. But if you look at the history of these ESG regulations, usually we have some countries that are always a bit more advanced than other ones, and France is one of them. So it could also be something that we can see coming in the few years, let's say.
Yeah, thank you. Thank you for the overview. I think it makes a lot of sense. And as an advisory firm, I think it would be interesting also to know what are the areas that your clients ask the most in terms of engagement for this thing?
Yes. So the main questions are, as I say, the extraterritoriality and how to. What does that mean to comply with the non-financial disclosure as a non-EU company? How to handle that? And the interoperability, because maybe you have US entities and the approach is not the same, the culture is not the same. So how to conciliate all the different approaches and requirements? We are also waiting for the SEC potential proposal about climate disclosure. So usually what we say is that, first of all, so the interoperability, they really worked on that, and it might not be an issue in the end. And also what we always say is to don't start from scratch, that you can build on processes that you may already have. Like, for example, if you already have an impact materiality assessment, you can leverage that. For example, if you will have to do an assessment of your risks, because the criteria could be similar, and you can, shift one process to another one, not with the same purpose, but you don't have to start from zero, and you can build on what you already have.
Makes sense. Makes a lot of sense, and I think it's a very interesting point because we now have in the panel, 3 very large banks that are very engaged as well on the UNEP work, including the PRB, Natural Banking Alliance, and I think this is also something that is quite critical to understand what are the key issues. I'm going to turn to Marta that are driving your commitments and regulatory compliance. And I think, for example, data is a key issue that is compelling to both aspects, and I wanted to know a bit more from that side as well.
Thank you, Daniel, and hi everyone. It's a pleasure to be here. So, from working on a bank, I think we have gone through a journey in sustainability. No, there was some years ago, very recently, where voluntary commitments were no doubt the main driver of the agenda. In that sense, banks and of course other corporates either joint groups, such as Net Zero Banking Alliance, Principles for Responsible Banking, and set their own commitments, such as, for example, Santander set 10 responsible banking commitments back in 2019. Now we are seeing some shifts and seeing how regulation is gaining relevance as part of being a driver in the agenda, while at the same time, and as we have all commented, it cannot be the only driver. We need to keep gaining our ambition and delivering on previous existing commitments. So I would like to cover in my intervention 3 main building blocks. First, why regulation is gaining this space and what are being the challenges for banks. Second, what is being Santander's sustainability agenda focus, more linked to regulation. And finally, some food for thought on what could be next to ensure we succeed. No? So starting with the first one. I think regulation is becoming intense and it's becoming relevant in the agendas for 3 main reasons. First of all is because the volume is being just massive. And for example, the European Sustainability Reporting Standards with more than 1,000 data points is a number hard to forget, no? When it comes to implement it. The second is data, and this has also been covered this morning. We banks are not autonomous for reporting. We need to gather data from our customers, and currently this data is either non-existent or with low quality. So on top of all the reporting efforts, we are devoting time to ensure or look for data sources with better quality, compare alternatives, and devote time in building solid proxies, as regulation, thanks, sometimes allow for it. But this is time consuming also. And the third one is consistency. And we have talked about interoperability. This is fundamental, and we are making great steps in the right direction between ISSB, EFRAG, GRI. This is fundamental, no? But consistency in the technical level is also very needed. Of course, this regulation is still nascent, but when it gains more maturity, we should try to aim for less complexity, no? As it was said also in a panel before. We have, for example, a green asset ratio according to the European Commission, another one which is according to the EBA. We have the green asset ratio and the BTAR also, which are similar but different. We have SFDR, how it compares to EU taxonomy, or how the reporting requirements for our corporates will enable us to deliver on Pillar 3. So these technical issues, which I agree they are identified and we are working on, but at this time it poses implementation challenges for banks. So the second building block, what is being Santander's sustainability agenda focus? And I would say there are 3 main themes, which are climate, connected to climate, green and transition, and finally disclosure, which I agree with you, Tennessee, the disclosure regulation is now being intense. So on climate, and based on NZBA, or in line with NZBA and in line with the ESRS, we are working to set the targets, sectorial targets in our climate most intensive sectors. We are also trying to evolve our TCFD disclosures towards a transition plan that is according to ESRS, and at the same time addressing ECB supervisory expectations and preparing for climate stress tests. Those are, I mean, I'm not saying anything you, I'm sure all banks are working on. On green, we are working to tag our operations, our lending, based on green criteria. And this is to comply both with the regulations, such as the European taxonomy, and for business needs. And on top of green, what we want to work further is on transition, because green is only one part of the equation, the top one. But as it was mentioned before also, it's important to go from brown to green, and this is the transition space. We need to understand, and we need to be there to help. And the third is disclosure. And disclosure, after releasing the second Pillar 3 statement now in late August, so very recent, we are start works to implement the CSRD. So, for example, we are starting our materiality assessment, the double materiality assessment based on CSRD, which is becoming interesting, and understanding further what would be the disclosure requirements we will be subject in 2024. And so, of course, as I mentioned before, regulation is not the only driver of the agenda. So on top of that, we have our voluntary commitments. We have, for example, financial inclusion. We have women in senior positions. We have our own environmental footprint. And we need to keep an eye on other upcoming topics, such as biodiversity, nature, financial health, or the corporate sustainability due diligence. And just to finish, if I have 2 minutes more, thank you. What would be, what's next? How to keep moving forward? And I would just want to share with you three main ideas. First of all, this is about regulation, but we cannot forget the overarching goal, no? And the overarching goal is to support transition, to align our portfolios, to deliver on the SDGs. Too much regulation, I mean, some regulation is needed. Too much regulation, too complex, too soon, makes us focus maybe too much on just compliance and give us less time to think of solutions to really finance the transition for our customers. No? That would be my first thought. The second is, and we have commented, implementation. There is a lot in the table, so it would be very welcome, and I agree it's being now the focus, but we need to digest and we need more guidelines to implement. No? For example, the guidelines that are being issued to implement the materiality assessment or to understand how is the value chain conceived for the reporting requirements, this is very needed, at least for banks, no? to ensure we're all understanding the same and progressing. No? And yes, of course, and finally, join forces. We should all move in the same direction to ensure we help each other. And here I just want to say that it's understandable, it's desirable that voluntary commitments go beyond regulation. But now that regulation is having such a space in the sustainability agendas, the more we can leverage on voluntary commitments to also respond to regulation, the more useful it would be for banks. And here I just want to finish sharing an example that happened to Santander. When performing our double materiality assessment, we start looking for tools that could be useful for us not to make this assessment, and we thought that the UNEP impact tool could be a good one. So we started talking to the teams in charge of the tools, evaluating how it could serve or what would be the approach, and it has been extremely useful for us. So the more we can ensure we leverage on previously existing tools that are already available for now regulatory compliance also, I mean, this is very welcome and useful for banks. Thank you.
Thank you. Thank you, Marta. I think that is also a good publicity, I think, for us at UNEP that we have been doing things that are actually now helpful as well in terms of the regulatory compliance. Of course, I mean, we are not planning to interpret the regulation or something similar, but it's more about what are the complementary elements and how you can go forward. Okay, so I think that has been very, very complete, very clear, and I would like to turn to Christian now, to focus a bit more, I think, on the risk aspects, and to look a bit more concretely, what we have heard from Patrick in the intervention, what we have heard now from the CSRD as a key driver. So what do you think, for example, of the Pillar 3 disclosures, the ATS that are very concrete, and how are you approaching it?
Yes, thank you very, very much. Good morning, good afternoon to everybody. In my intervention, I'm going to give some broad reflections. I think many of the issues that were mentioned, some of the keywords that were already mentioned, perhaps some insight or some thought on some specifics. Regarding the mandatory disclosure requirement, as what we have seen by everybody, it was commenting, is a great acceleration of all the process. I think that nobody is going to deny that, of course, climate change and all the sustainability issues are the top priority in regulation by policymakers and also by banks. What I would like to just to comment, that perhaps taking a comparison, the process with prudential regulation, it has usually okay, these disclosures are developed. And there are many things, many ingredients that were already commented. Usually, when you start to think on disclosures, what you need are 3 ingredients. The first one is some common definitions and common concepts. The second is data based on that common concept, because you develop some uniform standards. And then you move, usually, before disclosure, you move to reporting to supervisors. Okay? And then you move to disclosure to the market. Usually, it's more or less the process. I think that here we are trying to do a lot of things at the same time, and that might, I perfectly understand the motivation, but what I'm going to argue is I'm going to provide 2 examples where if you don't have the right concept and the right data, the disclosure could be a little bit biased or even misleading. Okay? That's the first point. The second point, it was also mentioned, I think Patrick mentioned all this engagement with supervisors. And this is key in the sense that usually how the voluntary disclosure evolves, they evolve from this interaction with supervisors because they are trying to measure some risk, and this is where they are engaging and interacting with the banks. And we banks, where we develop our voluntary disclosures, from the interaction with our clients, with the different stakeholders. From these 2 things, you are starting to develop a common language, common concept. You started to report to the supervisor give you feedback, and little by little, you are building this common ground that give you the disclosure. So supervisor and the interaction with supervisor is very useful, and particularly useful, and this is my third point, is because we are in a learning process. So the supervisory approach, give you that flexibility that you need. It was also mentioned by Patrick before, this idea of accepting little inconsistency, of course, because we are still building the 3, almost the concept, the data, and the disclosure at the same time. So I think that could be useful. Of course, I'm not denying the idea of mandatory disclosure. This is a well-known regulatory tool for the pillar 3, no? Or the 3 pillars that we know in regulation. Of course, it's important. It's main source of standardization and comparability. That's very difficult to achieve all of a sudden from voluntary disclosure. So I think that it is important and it is relevant. But what I'm trying to argue is, and I move into the specific, that there are 2 clear examples where you may think that you have the perfect disclosure, but you don't have the data or the concept behind, the information would be not comparable or just misleading. The first one is very simple, and I think it's something that we all banks are facing. A lot of information and the data that is available come from larger companies. No? Larger companies have better and more resources to collect data. They can be audited, the control. So the more reliable data come from larger companies. If you make a disclosure based, any KPI based on larger companies, it's going to give you a quite biased picture. And of course, in a country like Spain, SMEs are a key part in the economy, and that picture is not going to be representative of the SME situation. That's the first example. Then one other example that we were talking with colleagues in the bank come from carbon reduction targets. We know that carbon reduction targets have to be disclosed both in the Net Zero Bank Alliance and also in the Pillar 3 disclosures. This is a very simple KPI, and it is well known. There are a lot of tables on this, but it is quite different. You calculate this target, or you inform on this target based on the total credit granted, that it is the use credit plus the limit that you can give it to a company. Then you just give it on the use credit. It is completely different. Now, if you want to add the value chain dimension, you have to define at what value chain you are going to cut. This adds other complexity, and it's also quite different. So, in the nutshell, I think that we have to recognize some of the. I'm not saying that we don't have to speed up. What I'm saying that we have to recognize that disclosure is just one tool. In the prudential is one tool borrowed from the banking regulation toolkit, and has its own limitations, Perhaps we need some other tools, but to complement, and be aware of the limitations that we have with this tool. Just to give you other example, if we move to more, let's say, more kind of prudential ratio, for example, the green asset ratio. The first thing that comes to my mind to a bank or regulator is the solvency ratio from Basel. The Basel ratio, okay, the last reform were agreed in 2017. We are still implementing in Europe. US announced their implementation. It took 50 years, 50 years to develop the ratio. I'm not saying that we need to wait 50 years because, of course, this is a key objective, but just to give some illustration of some of the limitations that usually regulators, banks, and everyone has when thinking on these tools.
Thank you. That makes a lot of sense. And I think we have seen as well the similarities on Pillar 3 templates as well, how we implement the Net Zero Banking Alliance, and we have worked on that. So yes, that's something that is clear. And of course, I mean, but the urgency of the problem still remains, and that's a bit of the balance that I think that everyone is here playing between regulators and financial institutions, but at the same time within the financial institutions between the mandatory and the voluntary aspect. So it's all quite complementary. And I would like now to turn to Frida, just continue, looking into with a risk perspective in our minds, but also looking beyond, connecting with the business front and how are we dealing with this, focusing on how do you see the interplays between the EU framework shaped by the EU taxonomy and all of the other elements and how you're approaching it from Societe Generale's side.
Yes. Thank you for inviting me. I'm happy to be here and to discuss this important topic. As we have seen, the EU set up an ambitious regulatory framework to speed up the transitions. And this is a way to move forward to answer to this emergency we are all facing. In this regard, I would like to highlight two angles of the regulations. The first covered the bank's transition plans, and the second, the financing of company transitions. Today's banks is based on a voluntary, today's transition plans of banks is based on voluntary commitment. And tomorrow it will fall, among other things, into the prudential supervisions. Banks such as Societe Generale have been committed to align their financing portfolios with Paris Agreement, and now within the Net Banking Zero Alliance with a 1.5-degree scenario. From now on this process of aligning their portfolio, we are moving from voluntary to mandatory, and in particular with the adoptions this summer of the CRD6 banking package. This requires banks to set up transition plans with targets and actions consistent with the EU objectives, and in particular the EU climate law. And here several observations could be made. The EU climate law include the objective of carbon neutrality by 2050, as well as the reduction of carbon emissions by 55% by 2030. The challenge here is that this intermediate target is a holistic one, a macroeconomic one, with no split into a sectoral intermediate trajectory. So it will be a challenge for banks to respond to this requirement. And the second point to note about these transition plans is that this alignment of portfolio objectives, which were an integral part of bank strategy, will now fall into the supervision framework and prudential supervisions, which means that the supervisors may be able to challenge the management of the alignment of the portfolios. So one of the points of attention here will be to maintain the objectives of the prudential framework, which is to ensure the stability of credit institutions and the broader financial systems. The second angle and critical point is the financing of corporate transitions. And to cut the G funds, we need not only to encourage the reduction of finance emissions, but also to finance the reduction of emissions. And maybe the first point we should highlight here is that banks are ready to finance more green projects. But one of the issues they are facing is the existence of creditworthy green projects. And the actual game changer here is for public authorities and banks to introduce risk-sharing mechanisms in order to make this green project ready to be financed by banks. Now, if we look at the sustainable finance regulations, we have two signals. The first, and on the one hand, we have the European taxonomy, which has an activities-based approach and which identifies the activities at the target or almost at the neutrality target. Its objective is to set the target, and we need the targets with a holistic approach via the do not significant harm principle. But the point is that for the moment, this approach only covers a small part of EU economy, more or less 5%, and does not include the transition. The second signal of the regulations is to finance less emissive sectors. And for example, since this year, Pillar 3 banking disclosure rules require that banks publish granular information on their exposure to emissive sectors. What's missing then are the signal needed to finance the decarbonization and the reduction of emissions. And in this respect, we should welcome the communication of the European Commission, which recognizes the need for finance the transitions at a corporate level and not only at the taxonomic level, and in particular on the basis of transition plans. But this also highlights that we need complementary tools. That is to say, the need to have macroeconomic sectoral pathways in order to compare them with the trajectory of companies and corporates, and also the need to have credible transition plans from corporates in order to identify which corporates are in the relevant trajectories. In this respect, when it comes to Generale corporate purpose loans, the large-scale lack of reliable and comparable data on sectoral decarbonization and on transition plans from corporates may constitute a significant issues. And before CSRD and internet standards on climate are applied, we'll have to continue to rely on proxies provided by external providers or on information gathered on a bilateral basis. We also know that regulation does not always encourage the funding of the most innovative projects and disruptive technologies. Capital charge in equity investments are too high today for banks. And we have also a concern with the so-called infrastructure supporting factors, which enable certain strategic projects to be financed at a lower cost by banks, and which will be replaced by a green supporting factors based on the compliance with the strict criteria deriving from the taxonomies. And the concern is in particular with the consistency with the Net Zero Industry Act. As you know, this act aims to promote the green industrialization of the Europe, and the link between the capital charges and this act are not as clear as they could be. And we are still looking at a few interpretations issue, such as in what extent we must apply the strict criteria of the taxonomy for these innovative projects. The technology, the disruptive net zero technology inherently present a risk of technology And it is critical that these infrastructure supporting factors can continue to act as a good lever for financing this innovative project.
Thank you. I think we have covered a lot of ground with everything that we have said here. And I would like to land it a bit more before we go to the Q&A and then for lunch. That is to understand a bit more, we see now that, of course, climate change mitigation is the key aspect here for reaching net zero, how we are going to work forward. And I think that's been the key aspect that all of you have been covering as well. I think that from ECOFACT, the questions that you're getting are very clear on that front. But we see that also social aspects, biodiversity, adaptation are gaining ground. So I wanted to understand from your perspective, how do you see the interplay between all of these things coming together, and what is for your institutions, what do you see are the most pressing aspects that are going to shape the next actions? Maybe starting all of the way from Frida back to, yes. Thank you.
So it's clear that ESG disclosure, not only on climate, but also on biodiversity, are going to be even more important. Since ESG data is the raw material to direct the capital flow towards sustainable activities. And moreover, during the transitional period until the implementation of CSRD, there will be more data collection on bilateral basis and on proxies from ESG data providers with a greater risk of unreliable information. And it is even more important for banks with international activities, as it also depends on the local implementation of international standards. But maybe just to conclude, we have an EU regulatory framework which is well sophisticated and may inspire international discussions. And we can also highlight that the regulatory approach implies, as you said, compliance process for financial institutions. So it is clear to ensure that the allocation of resources is not only focused on the compliance side of the regulations, but also on operational and strategic business implementation. So that's why we are going to need more consistency in between the standards between the international standards and the EU standards, but also between intra-EU standards.
Yes, thank you. I would agree that one of the topics that we see the next stage is nature. For example, biodiversity, water, deforestation. Some of these is already driving some of the regulatory agenda. That's the first thing. Second thing, I think that the next stage, I think we most would agree, is the S, the social S in the ESG. There was a plan on the taxonomy, but I think that this is a very complex one because it doesn't involve the same type of data, the same type of definition. Maybe we need more qualitative analysis, so this is the second. But I would like to connect this with the first question that you mentioned on the voluntary and the mandatory disclosure, like a first prudential tool. And I think something that we learned from experience, for example, in CaixaBank, moving from the Net Zero Alliance disclosure to the Pillar 3 disclosure, is that the process was rather smooth because we have started very early. That's what we talked before, no? This early interaction, is early voluntary disclosure. So that's allow us to make that step. Without that, it would have been very, very difficult. Very difficult. This is a little bit of the learning by doing. And for that, you need you talk about the challenges on the topic. I'm going to talk a little bit of the challenge for a bank. What we have made in CaixaBank is first on governance. Now we have a general directorate on sustainability. Okay, that coordinate is quite cross-sectoral area. That coordinate the work of different areas, involve a lot of people, a lot of area, a lot of expertise, people from risk, people of course from sustainability, people from business. Then you need, talking about risk as we talk, you need an internal control system. There you have the first lines of defense, the second line of defense, and so on. And of course, this is a very cross-cutting area. And even here, our representation, I think the 2 or 3 directorate generals of the bank are represented here. So that's a challenge for the bank, I think, to coordinate all this work, all this input that you need for a quite different risk from what we are traditional banks are used to deal, okay? And be prepared, give that early step that you need, that you already know you are going to need when the mandatory reporting or disclosures arrive. I think that would be the idea.
Few to add, being the third bank that talks now about what's next, I agree with you in terms of themes. I think nature is the next one. Indeed, supervisors are already talking about environmental risks beyond climate, so that is very intentional, showing what's next. I agree with you, Christian. Social is another theme to tackle, but it has more complexities, more geographical implications. So it's going to be maybe, I see it a little bit long term. I just want to add two reflections. To me, the next term, apart from new topics, I think it's key to embed ESG. I mean, this is all recent to some extent, no? And we need to move ESG from being something siloed or aside, not to be something in the core. And I think this morning it was mentioned, no? After making the commitments, the delivery starts, and the challenge is there. And the second thing is, for all this to happen, banks cannot be alone. So we also need other things. We consider climate as a topic that is already there, but really the delivery is not there because we are missing parts still, to really ensure, as you, Frida, said, that we finance less emissions and there are less emissions in the atmosphere.
Yes, so I would say in terms of regulatory agenda, yes, I fully agree. The next one is nature and biodiversity, and the next one is social aspects, of course. But maybe to mention that what makes the CSRD and the ESRS quite unique is that they include all of that. You have the environmental part, you have and included in the environment, you have biodiversity and nature. You also have social aspects, on workforce, but also value chain, and governance aspects. So that makes the ESRS quite unique and the most advanced standards that we have so far. So also to mention, you say the technical challenge that you have, and that I fully agree. In terms of regulations, you have a lot to do, a lot to implement, and the EU is currently building a framework that they started years ago, but they started with an idea of what the framework will look like. And so they started years ago. They already started to revise some regulations that they adopted years ago. So they are currently building this framework, and it will just be improved, and it's challenging even for the regulator on how to implement this framework. But in the end, so now we have the SFDR, we have the taxonomy, we will have maybe soon the due diligence directive. But linked to that, they are also implementing deforestation regulation, regulation about the batteries, and all these kind of regulations. So it's not only disclosure with the CSRD, it's a full framework that they are building, and it takes a lot of time, and it's challenging for everyone. And just to also finish with something that, Frida, you said about the credible transition, I fully agree, this is also a challenge. It's not only to do transition plans, but it's also to have credible targets. And I'm a bit surprised that this word was not mentioned already. That is the greenwashing. And that's also kind of a challenge, also for banks and financial institutions. That is also legal related, let's say.
Yeah, indeed. And I think Tony was also making reference to that before, to both greenwashing, greenhashing, etc. Okay, I know we are at time, but if you have one or two quick questions, please let me know. And just so you know, you are the only thing between us and lunch. So. Yeah.
think you were all very clear.
Okay. So thank you very much, and please join me to congratulate.